Welcome back, traders. It's Shane from KEH. I thought I'd take this opportunity to take you through our option tracking sheet, and this is how we basically track our options on a daily basis. It allows us to make our decisions as to whether we hold the trade or potentially close the trade for a 70, 80, 90% profit. And this is really where all the work is done, apart from obviously the hedge itself. So let's get into it and have a look at how this sheet is set up and how it allows us to make some decisions on a daily basis. So first and foremost, the trade was set on the 4th of January 2010, portfolio 100,000. It's a February contract in the March series. What that means is that we sold a February spread. Our options contract series ends in March. They're quarterly contracts, so this one was a March one. And remember that every quarter the options will cash settle. The ratio spread, it was one ratio spread. There's 59 days to expiry. Expiry date is 19/2/2010, and we basically have sold the 12/15 calls for 2.25 and sold the S&P 10/05 puts for 4.7. That's our sold position. So when we go into the market, we took a credit there of 6,950. Market, we don't just sell the spread. Our goal is to basically set a ratio spread in the market to take credit. We protect ourselves in the market by reducing our risk and buying some outside protection. So 3 calls, 3 puts, and we've got the 1260 calls on the outside and the 955 puts. Now remember, if we buy some outside protection, then we're basically paying money away. Once we've got a credit, we're going to pay some of that money away just to reduce our open risk. So our goal is to reduce that open risk down to a level where we know that our hedge will protect us in case there's a significant move on the market. Because remember that the goal of this strategy is not to make money on the futures, it's to protect our spread. So this is definitely a delta strategy. So we're looking to basically control our risk there in the market by making sure that once we set our spread in the market, that our futures are covering any potential move against our spread, or at least reducing the risk of that move where we take a loss and potentially give away 6 months of premium. Because at the end of the day, credit spread traders do well, but one bad move can wipe out a lot of profit. So, and if you haven't taken any profit, that's your first trade, then you could potentially be down a significant amount of your on your accounts. So the idea here is that we hedge with the futures. Now we've bought some inside protection there, a 1205 call and a 1015 put. So that's basically our position. Now the total cost to pay away, our inside protection was 2,162.50. Our outside was 2,250. So we're left basically on our spread with $2,226. And you can see here that every day that our spread's in the market, we track it. So I won't go through every single trade for you, but I'll take you through the most recent. So on the 15th of the 1st, this is our last trade. The market was at 11.32, remembering 11.32, our spread is 10.15 and 10.15, 12.15. So we're well and truly out of the money on our spread. We've got 35 days to expiry now. The significance there is that this is a time decaying spread, so we're looking for time decay or theta decay to work in our favour. So that's the other thing. We're using the futures as a hedge, or as a delta hedge, and we're using time decay to take advantage of our spread. So the closer we get to expiry, the faster that time decay kicks in. And remembering that after 30, or as I get below 30 days, that time decay will start to accelerate exponentially. So we get our settlement prices, which you'll get from Key Equity Hedge. Our sold calls are worth 105. Our sold puts worth 285. So that's the cost to close those out. Our bought position, our outside protection 0.2 and 1.6. And then we have our inside protection 1.6 and 3.2. So that's what we would get back now if we close that spread out. And our total cost to buy back the spread is our sold positions, which is 3,900, minus our bought position, which we get a credit for 2,550. So that gives us a negative 1,350. So what that effectively means is that we initially got a credit of $2,226. So we take that away from what it costs to close the spread out. So we're left with $876 as a profit. Now, so on Friday we had 15th of January we had an open short at 1136.75. So if we go back there, so that has an open credit of 1187.50. So we just put that in there as an open trade. So that's our credit there. That brings our tally up to 206.350. So that's what our total profit is on our futures. Now, as I'm counting on the futures to be profitable, we're counting on the futures to protect our spread. So if they are profitable during the time we're trading, that's a bonus for us. So our total open credit or profit on this spread is $3,030.50 or 3.03%. So we're actually up 3% so far in early trading. 15 days into the month, and we've already collected 3%. Now that's open. That's an open trade, so it's not closed profit. So we've still got a fair way to go on our spread. We're still protecting it. We've got an open futures position, so it's early days yet, really. And as you can see, $876. We're not even at 50% of our spread, so we've got a long way to go before we look to close that out. So traders, thank you for your time. I hope you got a little bit out of the explanation, and you can see how we track this on a daily basis. Some of the decisions we're looking to make as far as closing the spread out. Remembering that 70, 80 or 90% on our options, that's where we're really looking to close the spread out. So at the moment we're well below 50%. So no decision yet for us, and we'll just track this on a daily basis, and we'll let you know. Thank you very much. Cheers.